A perfect storm. That's the best way to describe the red-hot housing market we've seen from coast to coast during the pandemic. This record-breaking housing market was spurred by a combination of recession-induced low mortgage rates, remote work allowing buyers to sprawl further and further away from their workplace, and a demographic wave of first-time home buyers entering into the market and taking advantage of the record low interest rates. On top of all of that, you've got to take into consideration the years of underbuilding, meaning that there simply aren't enough homes available to meet this demand. Put it all together, and what you get is a record growth in the 2020 and 2021 housing market. But the big question is, how much longer will the housing boom last? After all, home price appreciation of 19.9%, a 12-month record set between August 2020 and August 2021, can't be sustained forever. Already there are signs that the housing boom is losing some steam. We're seeing seasonality, a cooling off period that happens like clockwork most years. Seasonality returned to the market after it was absent during the holiday and vacation stretch last year. That's not all. More home buyers are finally beginning to push back against surging prices. In October, 60.3% of sales involved a bidding war, which is down from the all-time high last April of 74.5%. There's also the increased likelihood the Federal Reserve will raise rates to tamp down inflation. Rising mortgage rates would price out some buyers altogether. Now, what does this mean for home price growth in 2022? Buyers and sellers alike aren't going to get much peace of mind from these forecasts. The economic models don't produce anything close to a consensus. Some of these home pricing forecast models predict growth next year that will go down as one of the highest on record. Others are forecasting a rate of appreciation that would be the slowest in more than a decade. Let's take a look at these models and also look at why there's so much uncertainty heading into next year. What is Zillow and Goldman Sachs predicting for the 2022 housing market? Both of these two giant companies are on the high end of the housing growth spectrum. Zillow projects home prices will increase 13.6% between October 2021 and October 2022. Goldman Sachs forecasts a 16% pickup between 2021 and December of 2022. To put these numbers into perspective, the largest 12-month housing price growth in the lead up to the 2008 housing crash was 14.1%. Simply put, both Zillow and Goldman are predicting a slight slowdown from the 2021 pricing, but are still predicting a double-digit price home increase in 2022. Goldman Sachs recently wrote, "The supply-demand that has been the basis of our prediction for a multi-year housing boom remains intact. Of all the shortages afflicting the U.S. economy, the housing shortage might last the longest." So, what's going on with the housing market? Well, neither Zillow nor Goldman Sachs sees the huge wave of first-time homebuyers letting up. We're in the midst of a 5-year period between 2019 and 2023 in which the 5 largest millennial birth years between 1989 and 1993 are hitting the all-important first-time home buying age of 30. According to their forecast, there won't be enough homes to satisfy all of that demand next year. Since 1980, home prices on average have climbed 4.6% per year. Over the past year, price growth of 19.9% is 4 times that previous level. Now for the good news for would-be home buyers. Among the 7 of the largest forecast models, 4 predict we'll see price growth in 2022 fall back closer to the historic average of 4.6%. Those predictions include Fannie Mae and Freddie Mac, which are predicting U.S. home price growth of 7.9% and 7%. That's slightly higher than the historical norm of 4.6%. However, it's hardly the eye-popping numbers of 19% home growth that we've seen during the past 2 years. Two of the forecast models released by Redfin and CoreLogic are predicting a 12-month price growth falling to 3% and 1.9%. So what do the models predicting substantial price slowdown have in common? All four are expecting price growth getting chopped down by rising mortgage rates. As of Monday, the average 30-year fixed mortgage rate stands at just 3.1%. By the end of 2022, Fannie Mae projects interest rates will hit 3.4%, while Redfin's model is predicting 3.6%. Those jumps in interest rates make a larger impact on the housing market than it might appear at first glance. For example, let's say a home borrower took on a $500,000 mortgage. At 3.1% mortgage rate, they'd see a $2,135 monthly payment without taxes and insurance. Now let's say the interest rate increased just 0.5% to 3.6% as projected by Redfin. That payment would rise to $2,273, or nearly an additional $50,000 over the course of the 30-year mortgage. Another unknown: will corporate America begin pushing harder in 2022 to bring employees back into the office? If the workplace is less work from home friendly next year, that could translate into fewer buyers in both second home markets like the Hamptons and the suburbs. CoreLogic recently wrote in the real estate data firm's latest forecast that as we head into the 2022 season, we expect some moderation in the current pattern of flight away from urban cores as the pandemic wanes and employees return back to work into office spaces. Now, there is one outlook that is relatively bearish on price growth. The Mortgage Bankers Association, a real estate industry trade group, is predicting that the average price of existing homes will decrease by 2.5% between the fourth quarter of 2021 and the fourth quarter of 2022. When you look closely at this model, it's easy to see why. The Mortgage Bankers Association is forecasted that the average 30-year fixed mortgage rate will increase from 3.1%, which it currently is now, to 4% by the end of 2022. Over the course of 30 years, that would add an additional $90,000 in cost to a $500,000 fixed rate mortgage. Even if the Mortgage Bankers Association's price drop comes true, it's hardly a housing crash. In fact, in that scenario, U.S. home prices would still be up over 20% from the pre-pandemic models. Now, if you've watched this video for this long, you must have found some value in it. Would you please hit the like button? I'd appreciate it, and it would help others as well. I'll see you on the next video.